What's up everybody? Welcome to the Stocks channel. My name is Cory and today in the stock market we continue to see big tech selling off with more Tesla stock capitulation. Are the big tech companies going to be too heavy to see a Santa Claus rally in the SP 500? First up, let's take a look at the SP 500 SPY ETF. So let's crack open this chart and see what's going on in the stock market today. Alright, so first I want to take a look at a weekly chart of SPY, and I think for a lot of the big tech companies I'm going to do a completely separate video because I want to start looking at some of the weekly and monthly charts on some of those stocks, and I don't want to make this episode way too long, so we will do that in a separate episode. Now looking at the weekly chart of SPY, I want to continue to remind you that this is still a bear market weekly chart of lower highs and lower lows, and we are now on week 4 after seeing the rejection from the bear market resistance trendline. And typically speaking, if we're going to get a bounce, it is likely going to be in this 4th week. So there is still a chance of that Santa rally to end the week while we are above 380. So if you want to hold on for hopes of a rally from this support, you need to manage your risk on the weekly chart on a close above or below 380. The reason I say that is because this is still a bear market, which means we are still looking for lower lows after we put in these lower highs. And you don't just want to go against the trend for any prolonged period of time while you're in a downtrend. You need to be very mindful of going against the trend. So on a breakdown below 380, we will be looking for that next leg lower, which is going to be down here right around 366. So pay attention to that weekly chart and weekly support at 380. Now jumping over to the daily chart of SPY, we are still managing risk at this daily support of 378, and there is still the chance that we do see an end of year rally into the first couple of trading days of the brand new year, which could in theory take us all the way up to any of these resistance levels above. So those upside resistance levels will be the gap fill just below 388, our resistance level right around 390, and then we have 2 more resistance levels at 393 and the gap fill just above 396. Those are all valid upside resistance while we're going against the downtrend, and yes, we are still in a very strong downtrend, especially while SPY is trading below a negatively sloping 200 moving average. So manage your risk if you're going long on this market above 378, and if you're looking for a good opportunity to go short on the market, you want to either wait for the break of that support at 378 or a rejection from any of this upside resistance. You could see price action is struggling to break above even a negatively sloping 5 EMA, so the bears are still very strong, which does increase the chance we do break down through this support. But if you're waiting for the price action confirmation, you're going to need to see a daily close below that support. Below the breakdown of the support, we will be looking for a retest of the lows in the 360s and the 350s. So this is going to be a very critical support, which could lead to the next bear market leg lower if we break down below it. On the NASDAQ 100 triple Qs, we were down 1.41% today, and the triple Qs made yet again another daily closing low, and we are just above the previous 52-week closing low at 260. So as you can see, the big tech companies that make up the majority of the triple Qs are very heavy, and they are very heavily weighted in the SPY, which is also why the SP 500 is struggling to go higher. So for that reason, there is going to be very critical support right here at 260, because if we break down below that, we are very likely going to see the next bear market leg lower in the triple Qs, which could take us all the way down there to 250. Yes, we can go lower, but that will be the next leg we'll be looking for possible support. So on a breakdown below 260, we could see some high volume selling to go down for that next leg lower. The critical resistance to break is going to be this level just above 269, and then the daily closing high just below 274. If the bulls can clear that resistance, then we should run up to 280 and possibly even close the gap at 283. So if we do see support holding up around 260, we could see it run all the way back up to 280 to 283. But from there, we will still be looking for another lower high and then continue down for that next leg lower in this bear market. So even if we do get some type of counter trend rally, you need to be very cautious that this bear market is not yet over, and it could be the next lower high before the next lower low. So the larger degree trend is still a bear trend while we're below our resistance trend line and below this negatively sloping 200 daily moving average, which is all the way up there at 300. So this is still a risk off bear market, so be very cautious going against the trend for any prolonged period of time, and you could tell from the moving averages we do have the full bear trend. In the Dow Jones, we were up 0.13% today, and the Dow Jones has now closed back over the 50 EMA for 3 days in a row, so there is clearly relative strength in the Dow. The Dow does have a gap to fill around 337.6, and then above that we could make another attempt at the previous daily high at 346. Critical support for the Dow is going to remain the 50 EMA at 330, and below 330 we have support at 327 and 325. If we lose support at 325, then we're going to continue into a bear market with the next leg lower at 319.5. On the Russell 2000 IWM ETF, we were down 0.67% today, and the small caps continue to close below all of the moving averages with the price action, but have not yet broken down through this critical support right around 172. Below 172, we're coming all the way back down into the 160s to retest the 52-week lows. So this is going to be the critical support for the small caps. The bulls need to break back over resistance at 176, 178, and there's a gap fill just below 179. But you can see from the moving averages, this is a bear trend and the price action is looking relatively weak while it's below the negatively sloping 5 EMA. So the bears can try to make an attempt at breaking this support, but we won't have confirmation of the next leg lower until that support is lost. On the ARKK ETF, we were down 3.84% today, and the bear market has not been very kind to this ETF, breaking down below one of my support downside possible price targets at $30. Now from here, anything is possible, and we're still seeing this very low volume selling, and the next downside target I have below $30 will be down here right around 28.37. This is clearly a very powerful bear trend in a long-term bear market now going on the second year of this bear market. So you need to respect the fact that this is a very strong downtrend that continues to make lower highs and lower lows. To the upside, we have a gap fill at 30.69 and resistance around 31.3 and 32.56. On the VIX, we were up 3.74% today, and the VIX tried to close back over the 20 daily moving average, but as you can tell, the VIX continues to get crushed every time it gets in this zone between 22 and 23. So from the VIX, we're not getting a lot of fear that you would see in a bear market, but we still have the VIX continuing to bounce off of this support level at 20. The next volatile leg lower in the bear market should see the VIX spiking above 24, and to maintain any type of bull trend, we need to see the VIX crushing down below 20. On Bitcoin, we're currently down 1.25%, continuing to find resistance below that 20 daily moving average at 17,000. Critical resistance remains 17,000 and 17,550, and below that we could come back down to the critical support at 16,000, and if we break critical support, our next leg lower will be 14,395. This is normally where I would go over the big tech companies, but I am going to do all of the big tech companies in a separate video and go into much more detailed analysis. So jumping over to the financial sector, you can see we were flat on the day, only going down 0.03%. And holding up above that 5 EMA, but still below the negatively sloping 200 daily moving average and 50 EMA. And if we do get a Santa rally, we should be able to close that gap at 34.49. The industrials were up 0.3% today, closing back over the positively sloping 5 EMA and just below the resistance at 99. And a Santa rally should be able to take us up to close the gap just above 100. The healthcare sector was down 0.26% today, closing down below the 5 EMA, but still above this rising 50 EMA, with the upside target being the gap fill at 137. The energy sector went up 1.07% today, with the price action closing back above all of the moving averages, and you can see this is starting to look like a double bottom off of this support at 82.6. This is a bullish pattern that could take us all the way back up into the 90s. We just need to clear this resistance at 88.5, and then we can see that next leg higher. So you can stay bullish in the energy sector as long as we're above 86.5. So jumping back over to the SP 500, we are still above the critical support, but a lot of those big tech companies are getting very oversold, and we are seeing full-blown capitulation in Tesla stock. So that is putting a lot of downward pressure on the S&P 500, which is very tech heavy. That doesn't mean the Santa rally can't happen. So as long as we're above critical support, you need to keep in mind this could still be a low volume melt up week that could last into early next year. We have big tech earnings right around the corner, only a month away or less. So there is going to be plenty of catalysts in both directions in this market, and you need to let the price action do all the talking, which means we can't expect that next bear market leg lower until we break down through this critical support. All rallies should be considered bear market relief rallies that should result in a lower high before the next lower low. So don't lose sight that we are still in a bear market of a longer term downtrend while we're below this critical bear market resistance. So manage your risk and make sure you're preparing for a brand new trading year, because I'm sure a lot of you learned very important lessons in the year 2022, and I'm sure a lot of you learned just how important it is to manage risk and have a trade plan that follows price action. Also, don't forget I have Bank Trade Alerts, which is an algorithm-driven trade alert service that only trades the ETFs TQQQ and SQQQ and sends you all of your buy and sell alerts directly via email and text message. You can learn more about Bank or learn how to subscribe by clicking on the link in the description of this video. If you're looking to become a better price action trader, come join us over at the Stocks Channel Trading Discord community where you get access to all of my intraday updates and analysis. You can find out how to join the Stocks Channel Discord by clicking on the link below. So thank you for watching, everybody. I hope you're crushing this market. And as always, I will see you in the next episode.